we go into second data and we see something, so we have to clear the worksheet. And then start entering as decimals. Remember that S&P 500 must be the X. And you are the Y to do this. So 0.0491 and then 0.1 and 0.1579 and 0.3 and then 0.0549 and 0.1. And now don't forget it's a negative, 0.37 negative and 0.55 negative and 0.2646. And I did this the other day and I got the wrong answer because I made a mistake. So just pay attention to what you're doing. And you will not make a mistake. So if I've done it all, I'm going to verify my numbers. And then I'm going to check stat. Oops. Second, I think I screwed that up. Let me see that again. What did I do? Okay. Did I clear everything? Oh my goodness. Anyway, I think I cleared everything out by accident. So anyway, what do you get? That's what you do. And then you ask for second stat and you get the information there. And what do you get? You find that the mean for UAIR stock is 11%. The mean for the market is 5%. The beta for the slope is 1.55, which you interpret as an index, not as a percentage. And that's the slope between the two of them. You can also get the variance from the calculator and you can get the covariance. How do I get the variance from the calculator? So the market returns are Y, so you would take SY and square it. That should be equal to the variance here. How will I get the covariance?
So I multiply the variance of market and the variance of there, right?
Close, kind of. Okay, so to get the covariance, remember that the correlation, so I'm going to write them in the simple letters because I think that's more likely you remember them. I don't know. So the correlation is equal to the covariance standardized, right? So that's what correlation is. So if you take the R times the standard deviation of each of them, then you'll get the covariance. So that's how you can find it. So you're going to get it by R times SX times SY is equal to the covariance. So you have to multiply things to get it. Is that what you were saying?
Not exactly, but yeah, something like that.
Okay. Okay, so you verify all of that, enter all the values, verify all the numbers, make this your exercise. I'll give you some time. There are my observations. There's my mean for X, which is the market, my standard deviation for the market. So what I can do is I can store that. And then for Y, that's the mean and the standard deviation. I can store that. And then I get my A, I get my B, and I get my R, and I can store that. So I take that times recall 1 times recall 2. And that should be, yes, that should be the covariance here. Okay, so remember those. I mean, this is not new. I taught you this before, but I'm applying it now. Okay, so I did it. Hopefully you can try that later if you didn't get it. So that's that. The symbols I use are the Greek letters.
I got that, just a slightly different number, but yeah, I did got it.
Good. And so I use the Greek letters because these are estimates. This is just a sample of historical data, but you should be able to do the same thing with ex-ante type data. Okay, so now let's put it together. Let's calculate the cost of equity. In other words, the required rate of return for UAIR. And to do that, we're going to focus on this volatile period, imagining that, you know, that it's going to kind of stay the same. It's going to, the next few years are going to be just like the next 5 years, because UAIR is a 5-year FING project, that it should stay relatively the same. So I'm going to use the most recent data. That's the 7 years or 6 years here. And so when I do that, the average T-bill rate is 2.365%, which you can calculate finding the average here. The average market return we already got at 5.11%. And then so because of that, I can calculate as an arithmetic mean. Notice that I'm not using RF. So we're used to seeing the market risk premium. I was writing it like this before. Now we're writing it like using the data. I'm just saying, just use the arithmetic mean of each. Okay, so that's a little bit, seems different, but it's because of this bizarre period that I want to just use the means of both returns in that period, because there's so much change happening. But what I'm going to do, another thing that I'm going to do is that looks different, is I'm just going to use the current T-bill rate as the RF out here. So what am I saying? I'm saying that investors want at least the T-bill rate, because that's secure, And then to be incentivized to take risk, they want to be compensated for each unit of risk as measured by the beta. They want to be compensated the market risk premium. So putting in my numbers, this is the current T-bill rate. I do not put 1% in here, okay? I'm going to calculate all of this as the average historical market risk premium. And so just follow instructions in the exercises so that you can do what it is I want you to do. In this case, I'm stepping through this using the average market risk premium here. And I end up with, wow, it's like half, right? This is half of 10%. It's very low. So it doesn't change the decision of UAIR to proceed with the project because remembering that the IRR of UAIR was equal to 10.26%. Or I will call it, it's like the IRR of the Bahamas project. I think I call it sometimes Bahamas, sometimes UAIR. But so definitely this is better than 5%. Any questions? Okay, so what I asked you to do in the what happened? Did not come. So what I asked you to do here on your case part 2 is to use the dividend growth model as well to estimate the required rate of return. But before I do that, I am going to introduce just all of the historical data to see if I get a different result. What if I used all the historical data? Not just the last 6 years. So I'm going to go back and use all the data between 1928 to 2010. And I calculate that 3.7% is the average T-bill rate, and that the average return to common stock is 11.3%. So now I recompute the market risk premium as the average historical market risk premium, and I get 7.6. So now this is going to become 7.6. I'm still going to use a beta of 1.55, and the RF I use will be the current T-bill rate. And look what happens. It's so much higher. So this is very dependent on the assumptions that we make. So now we have to make a decision. When I changed the range of his history from 6 years to 80 years, I get a much higher value. So I have to make a decision which one I'm going to pick. And what I decide is that I will stick with using the most recent data for a more reliable, up-to-date estimate of what's going to happen in the near future. Okay. And so I stick with the 5% figure that I got over here. But just to show you, you can get alternative measures, but there is a range still. It's between 5 and 12 or 13, practically 13. Okay. So now let's apply the dividend growth model. So I give you this information. I gave you the information on the price today. I gave you information on dividends, and we make an assumption. The dividend growth model makes an assumption. What assumption does a dividend growth model make? What is the assumption of the dividend growth model? No comments? The dividend growth model assumes, if you go back, the dividend growth model assumes dividends grow at a constant rate. So the firm can exist indefinitely. So dividends can be paid indefinitely, and we're going to assume they grow at a constant rate. So let's find that G. So let's find the G that they grow at. So what I'm going to do is say between 2005 and 2011, there are 6 periods of growth. So I force this equation. I force G to exist, or I try and solve for G if this relationship existed. So 1, 2, 3, 4, 5, 6 periods of growth lead me from 2005 to 2011. So this is the dividend in 2011. Okay, and then to do dividend in 2005 is this one. And I grow it 6 periods, and then I solve for G. Any questions about this calculation? So there's some algebra that you have to do here to solve it. No questions about how to get that? All right, so that means then once we find G, now that's my G, which I can store and then add 1 and multiply to find the dividend in the next year, 2012. So the dividend next year, so now I'm going to use the model, right? So the dividend growth model comes from, well, this is just with the assumption using the formula for returns, percentage returns. I'm essentially just taking my growing perpetuity formula for constant growth dividends and solving for I solve for I, okay? So that's going to be my expected return to you air. That's what it's going to be. And I'm using this technique as opposed to the CAPM. So I rearrange it and I do it this way because I know C1. C1 I know, G I know. And the price I know. Gee, I calculated C1 was given. Oh, no, sorry, we calculated C1 over here. Let me identify where everything is. Okay, so the C1 is here. G is what we calculated. And PV0 is given. This was the year 2011. That's the next year, 2012. So I'm calculating this for 20. The price in 2012. No, sorry, the discount rate that I'm going to assume is constant as well. Over this, I guess, over infinity and beyond. So that's what I calculate. I put my numbers in. This was C1, this is the price, and this is the G, and now this is what I get. So I'm going to call this our, our number 2. Well, it's actually a number 3 estimate. So we've estimated CAPM 3 times. The first one was here, where we used only the recent 6 years of historical data. The second one was here, where we used 80 years of historical data for CAPM. And then we did this using the dividend growth model. So this is another calculation of the cost of equity or the required rate of return. What do you think of that number? Comments? What do we think of that number? No thoughts on that number? Is it going to change the result? The decision? So since the Bahamas IRR was 10.26, we still invest in, in the Bahamas project. No difference. Okay. All right. So I just make some calculation here to show that we're going to just stick, we're going to continue using the capital asset pricing model. Since these numbers are not so different, it doesn't matter, but I prefer to use the capital asset pricing model because I don't like this very strong assumption that growth remains constant. So I actually, and it's not going to matter because I'm still going to invest anyways. The numbers are very similar. So I'm going to continue with the capital asset pricing model estimate of 5.27. And using my cash flows that I already estimated, I can calculate the NPV again. I don't have to, but if I want that, that also shows me, I already knew the answer, but to invest. What would have happened if I used the other CAPM estimate? With the 80 years of data? What would have happened? You would not have invested. You should not invest or recommend investing. Okay, so the assumptions that you make are can be very, they can arise, different answers can arise out of the assumptions that you make. Right. All right, so what next? We assumed here that UR is an all equity firm, and we assumed that the Bahamas project beta is the same as the UR's beta, because I used UR's data, I didn't use Bahamas data. I used the firm's data on returns. So let's start with talking about changing the beta to a Bahamas project beta. This is just to show you my modification of the CAPM using UR's beta put us here. So this is the IRR for the Bahamas project as calculated earlier, but what we just did was found that the beta of the project is 1.55, and that maps through from risk to return. So what you need, when I ask you, what do you need for the CAPM? You need a beta. You need either the beta, or you need a measure of expected return to get one from the other. Okay. So to use the CAPM, that's what you need. Well, you need three things, because you need the market risk premium. So you need returns to the market, and you need returns to the T-bill. But then either the beta or the expected return. So there's four variables here: 1, 2, 3, and 4. So you need 3 to get the fourth. Or you have two equations and you can have two unknowns and solve for the other two. So this is the risk, this is the return. Now, as we discussed at the end of last class, the Bahamas project is in the area that we call undervalued assets. Undervalued assets should be long. That's the position you should take. In other words, you should buy and hold or invest, if they're projects, in projects that are undervalued. Because you're getting, for that level of risk, you're getting more of a return than you even require. Okay, so let's look at, oh, what happened to my feel like there's some slides missing. Oh, because I'm only showing you half the slides, am I? Are there slides down here? No. And where are my slides about changing the beta? Oh, I guess I do it next. Okay, so there's two things I'm going to introduce here. I'm not going to do it one at a time. I'm going to introduce the idea that UAIR's beta is different from the Bahamas Project beta. And I'm also going to introduce the idea that investors in the firm are not only stockholders, that the firm finances its operations with debt as well. So what if the firm is not all equity finance? Then on the balance sheet, you see that the assets are equal to equity and debt outstanding, right? So what is owned by the firm is also what is owed to its claimants, the residual claimants, the shareholders, and the creditors who get paid first. So we use the symbol V for the value of the firm. The market value of assets of the firm are equal to outstanding stock and the outstanding debt. So just to introduce some symbols, S is the market value of outstanding stock. So that's going to be the number of shares outstanding times the current market price. The return to equity is the return per dollar invested in stock. And that will be under the assumptions of the capital asset pricing model related to the beta of equity. So we worked with this so far. Well, we worked with the CAPM and the relationship between risk and return. But now we introduce debt. The symbol for debt will be B, and this is the market value of outstanding debt. So this is the dollars, sorry, this is the price per bond times the number of bonds outstanding. The return to bonds is the cost of debt or the yield to maturity on a bond. And that is also going to be mapped through the capital asset pricing model to risk as measured by the beta of bonds, beta of debt. Okay, so the last thing to talk about is, well, I'm going to repeat myself and go a little deeper with this, but there's also a notion, not just of stockholders and bondholders, but an investor that is invested partially in equity and debt. And we're going to give this character a name. It's the average investor in the firm. The average investor in the firm invests as the firm does have its assets. It's financing partially in debt and partially in stock. So we're going to refer to the return to assets as a return to the average investor in the firm with leverage. Leverage referring to a firm that issues debt. The beta of assets is going to be the systematic risk of the levered firm. So this is the risk for the average investor in the levered firm. So I'm going to talk a little bit more to get us to understanding what this is. So just a recap of my notation. So what is the fraction or the weight of investment in equity if a firm is all equity? Well, the ratio S over S plus B, or S over V for value of the firm, is 100% S if it's an all equity firm and 0% in debt. If it's an all debt firm, it's the reverse. It's B over S plus B is 100%, and equity is 0%. But in general, the levered firm has average investors. They're partially invested in debt and partially invested in equity in the same ratio that the firm finances with debt and equity. And these are non-zero. They sum to 1. Okay, so again, I repeat this, and then I talk about, all right, so we imagine that market is in equilibrium. In other words, what the firm pays to its investors is what it requires to grow or to invest in projects. So we're going to take out, or we're going to extract the cost of capital or the required rate of return from the firm perspective by looking at what it pays out per dollar to its investors. And what we're going to calculate is called the required rate of return of the required rate of return of the average investor in the levered firm. In other words, it's the cost of capital of the levered firm. In other words, it's the weighted average cost of capital. Those all mean the same thing. So I'm going to produce a weighted average. This is the fraction invested in stock. This is the fraction invested in bonds or financed by bonds. And so this is what the firm has to pay out to stockholders and bondholders. This is just a weighted average. This is a expected return. Looks like different symbols. I'm going to call it the WACC. And so it just looks like a weighted average of, like, this is just a weighted mean that we've seen before. The only thing I want to point out is this term. Now, why is that term there? Why do I put that there? Where does that come from? What does it mean? So why is that there? I have a note here. Read the note, and then I'll talk about that. Nope. Okay, so I wrote a note here to explain why this is here. So this represents the payment to the average investor in a firm with equity and debt outstanding. So for every dollar invested, the firm has to pay a fraction to stockholders and a fraction to bondholders. However, there is a different treatment of the bondholders because interest payments made to bondholders are tax deductible. So because they're tax deductible, they lower the per dollar after tax. Sorry, they lower the taxes payable. So because of that, we are going to account for that by noting that this is the after-tax cost of debt. So since the firm pays bondholder interest payment of RB for every dollar invested, however, the firm also incurs tax savings of TC times RB, we have to take each dollar minus TCRB because they don't have to pay this, right? This is a tax savings, and we get this term. So that's where that term comes from. Okay, so the cash outflows of the firms to its bondholders and the cash inflows to bondholders of the firm for each dollar invested will be this. So that's what I have to say about return. In terms of risk, the beta being a measure of the sensitivity of returns, we're going to form, and the fact that the beta, we learned that the beta is a weighted beta, just like the expected returns are weighted expected returns on the capital asset pricing model, right? We looked at that. We looked at that at the end of last class. So then the beta of assets is also a weighted beta, where this is the after cost beta of debt after tax. Oh, or beta of debt after tax. It can, you know what, as long as, let's just say this, as long as you match, if this one's the after taxed, if this is computed from the after tax cost of debt, then this will be computed as the beta of assets after tax. You'll understand when you try the exercises. All right, so one last point is remembering that the return to debt is lower than the return to stock or risky assets. So we do expect that the beta will be low as well, right? So on the CAPM, this will be lower than the beta of S. So let's just say it's 0 on the limit. It becomes 0. So this will disappear. And then so you see that the beta of equity, if you just rearrange this, beta of equity is greater than the beta of assets. In other words, it's usually the case that by introducing debt, the beta of assets is mitigated, like it's smaller than the beta of equity. So this is a way this effectively, you know, lowers your risk. It lowers the return as well. It's like, you know, a combining, right? You're combining assets into a portfolio. Well, now we're combining equity and debt. And so because this is a weighted average where the weights sum to 1, the beta of assets will be between them, just like the expected return will be between them. All right, so let's see this exercise here. This is from the case, from the UR case. I give information about
In progress.
what's that? Was that my Zoom? Anyway. All right, so here's the information from question 3. Assume UAir is a levered firm, 53% of its assets financed with equity and 47% financed with debt. Estimate the WACC. Okay, so there you go. 53% is financed with equity and 47% financed with debt. 1 minus TC. This is given as the yield to maturity for debt, which is up here, right here. So it's given as long-term bonds are currently traded for 6.04%. And I do not say, I don't tell how long the term is, but I do mention the rate, the yield to maturity. So we put that in there. And that's here. And we already calculated the return to equity here. All right, so then you put it together and here you get that introducing debt at 6.04%, it lowers the required rate of return from 5.27 down. So this would be our, so what did I lose track? Let's see how many estimates we made again. So we made 3 estimates. So this will be our 4th estimate. This time we estimated WACC as the estimate of cost of capital. So this is estimate number 4. So it's still going to give us the same decision because it's still, well, it's of all the others except for the 12% estimate, it tells us that we should invest in the Bahamas project. The final thing to do is to consider, what about if the beta is wrong beta? What if UAir's beta is not as high as the beta for UAir? I mean, for Bahamas. What if the Bahamas project has more risk, greater sensitivity to market returns than the UAir itself? Now, how could we find this out? Well, if we've never flown to Bahamas before, then we won't have the data on our own, but we could find some industry data of other airlines that fly to the Bahamas and observe or monitor their returns and estimate a beta. So we get that information like we did on the first slide today. We get information on market returns over the period, that we have data on the returns to the airline that's flying to the Bahamas, and estimate betas from there. Now, let's say no one else did fly to the Bahamas. Let's say we're the first ones to do this, or in general, for startups that don't have previous data, they can't find a comparator. It's not gonna be so obvious what to do, but you just make several estimates, to related firms, or as comparable as you can get, to come up with a beta. All right, so I suggest let's use 5.5 and see what happens. So this is a high end measure of beta that it came up with. And I say that its Bahamas line is much more sensitive to market returns. So for a 1% increase in returns to the S&P 500, US Bahamas returns will be 5.5 times higher. But that's risky if there's a downturn in the market and there's a real loss, because this would be a loss of 5.5 times worse. So anyway, at any rate, let's try this number and see what we get and how things change. So recalling that RF was made 1%, the historical market risk premium, I'm going to use the average from the recent history. So this measure here with 5.5, and look how this is our fifth estimate, how it shoots up to 16%. And of course, now we're going to reject the Bahamas project. So we really need, this is just to show you the assumptions will change your result, and you want to be as robust. Like if all these five were very close, we would be confident, we feel really confident in our estimate, but there's some volatility here or difference in our estimates. So we have some thinking to do. In this case, when we recalculate, we get 10.332, and now we see that the IRR that was estimated of 10.26% does not exceed that. So do not invest in this case if it's that risky. So you see how the different variables influence the measure of the expected return. Now, of course, it's going to affect the WACC. Are we recalculating the WACC? Yes, we are. Yes, we are. Did it right here. Now, it will go down, but from 16 to 10, still not reason to invest. All right, so that leaves us with this exercise. Now, this exercise considers 3 asset classes. So the firm issues common stock, bonds, and preferred stock. Now, preferred stock actually has preference over common stock and a commitment of the firm to pay a dividend. And so I'm going to introduce that idea here, and we're going to solve. And we're going to solve this problem, the last case, or the last exercise, or the second last exercise on the platform. I have this version here. I've already marked it up. Let's see if I have one. So I'm gonna download it. Okay. Well, that's not the one. Oh, that's confusing. I put it in the wrong place. Let me see. What did I put here? That's right. That's right. Okay, so then I just have the solution, but not the problem. Gosh. Back. That's the next one. Right. Okay. So I have the wrong one here, but we can just follow here. So I'm going to do it in 3 parts because it has 3 pieces. The debt, the preferred shares, and the common stock.
Professor, I believe you're in mute.
Have I been in mute this whole time or just one mute recently? I don't know how.
Just recently, just when you started explaining about this example.
Oh, I must have just touched it by accident. Okay. Or I don't know, maybe it did it automatically. All right, so I've underlined the components of information to compute the return to debt and the total outstanding debt. The market value of total outstanding debt. So that will get us these terms here. So I'm beginning with the book value because the book value, 736 million, can tell me how many bonds there are. So I know that each bond is $1,000 face value in the books per bond, okay? That's where that information goes. So if it's 1,000 per bond, how many bonds are there? There's 736,000 bonds. So that means, so what's the market value? We need the market value. Now the market value is different from the book value. Market value is what it's currently selling for. $834.18. All right, so then what is B? That's right, Luis. So you should store this number. You don't want to have to write it again. The next thing to do is to get the R. So we got this, we got this, we got this, we got this. Now we need RB. How do we find RB? What is RB? RB is the cost of debt. It's the yield to maturity. Now, we've learned several ways to calculate the returns, but we got to work with what we've been given here. So we have information about interest payments. We have the price, we have the years. So do we have everything we need? Because we know that the value of a bond is equal to an annuity of a payment. Let's do it like this. Right, I'll put in the symbol for RB here. So notice I'm just using the symbols like, I'll just put the original. So this is what we say it would be, right? From the formulas for bonds. So this is what you remember. Well, you have somewhere. So what do we have? We have the price. We need the payment. We have this, obviously. And then all of these I's are going to be RB. So that's what we're going to solve for. We're going to be solving for the rate. This is the face value over here. And we know T is 20. And they're annuals. So all we really need then is the payment. So find the payment. So what's the payment? Well, we're told that the debt payments are 72 million per year. They're made annually. And there are 736,000 bonds. So what is the payment per bond? So taking 72 million divided by 736,000 gives $97.83 as the payment. So putting all that in, then in your calculator from left to right, 20 into N, RB or interest is what you want. $834.18 is the price, the negative, and then you receive the payment of $97.83, which I round because payments are made in dollars. And then 1,000 you get as well. And then compute interest. So you get that RB is equal to 12.0034590. And you can store this amount as well. So we have the return to debt and the return to debt and the debt outstanding. So those are all done. Questions? Okay, so that's done. Let's now work with the preferred. Or we can do common stock and then preferred. So I'm going to leave that there and take this information. And now let's highlight the information for preferred stock. Let's do preferred stock. So preferred stock has a 1 million shares outstanding with a book value of 100 million. And then preferred shares are presently selling at $85 per share with a constant dividend. Okay, with that information, can you find? We need to find RP and big P. So let's do the same thing we did before. Let's start with the book value. What's the book value? $100 million for 1 million shares. The price is $85, so it's $85 per share. That's the market value. So then SP, or P we're going to call it, if we're going to use that formula, is equal to $85 million. Because there's 1 million shares and it's $85 per share. What about the cost of equity for preferred stock? So we have P, and now we need RP. So working with the only information we have is a constant dividend of $6. This is the price. It's constant, there's no growth. So what do we know about the relationship? We know that the price should be a constant dividend. That should be the formula. So with that formula, I'm going to put the price and the dividend in, and I can solve for the return. The price is $85. The constant dividend is $6. So I can find RP or I. So RP is equal to 6 divided by 85, which is 7.0588235%. So we can store this in 3 and this one in 4. Am I being consistent with my numbers? Let's do it the other way around because we'll have oh no, that works because I did the market value first. Okay. Any questions about that? So that's all the information I had. I just used my basic formula for valuing stock. And now for common stock. So I'm going to do this one more time. I'm going to take the original problem. And now let's underline the information for common stock. Common equity of 44 million shares with a book value of $1,421,000,000. And then also common shares paid a dividend of $4 this year and sell for $32 per share. And common dividend is expected to grow. There's growth in that dividend or in that asset. So doing the same thing. So this is for common stock. Book value. The book value is $1,421,000,000. The number of shares are 1 million. And the market value is $32 a share. Or the total of S equals to $32 million. Did I make a mistake? 44 million shares. I don't know why I was thinking a million. So 44 million shares, not a million. So that has to be recalculated. Where did I read 1,000,000? That was from the preferred. Okay, so for the common 44 million shares, it's going to be 32 per share times 44 million. I'll just do this. So S is equal to 1,408,000,000. Okay, so now let's get the return on equity for common stock. What information do I have? I have information on the dividend paid this year, be careful, and the price and the growth rate. So this is the dividend paid this year, so that means I have the dividend this year, so I can figure out the next dividend. It's going to be $4 times 1.05. I know that this, oops, that this is 5%. I know the price today is $32. And so I just need to find RC. And what do you get? So I'm going to store this one in 5, and this one is going to be stored in 6. $18,125. And you store that in 6. Questions? Any questions? So what you're going to do mapped out here is first you're going to calculate V, which is going to be the denominator for each of these parts. And so you're going to do recall 1 plus recall 3 plus recall 5 and get V. And then you're going to put in all these other numbers that you have. Write it down so I know what you're doing. And then multiply it through. So since the test is by distance, you know, if it helps to organize things, you can use Excel, but you do have to write it down for me, what you're doing. If you're going to use Excel, then you got to put a formula into the Excel spreadsheet. It turns out that the answer is 14%. So you can practice with that exercise, and then there are some more smaller ones. You know, they're long as I ask several questions, but they're smaller piece by piece broken down. I tried to break this down in pieces as well. Okay, so are there any questions for me? So the course, all I was able to do was focus on valuation, firm valuation, which brought us through many aspects of finance, talking about returns and the relationship between return and risk, and developing the capital asset pricing model ultimately to help us find a appropriate risk-adjusted rate of return for the valuation of firms' assets. So we can use this in project analysis, and I think things come full circle. So, any more questions for me? Comments? As I mentioned before, you know, my tests are based mostly on my notes and my exercises that I give you, but you can also get practice off of Connect. So doing those Connect exercises, it just helps. These are exercises, it's practice. So that completes what I wanted to show you. Do you have any questions for me? Are there any exercises or questions from the platform that you'd like me to look at? Or are you calculating away right now, trying to get that number? This is also good. Oh, I closed my dashboard. So here was an exercise. I think it's this one. Either that one is good. Well, they're all good, but just relevant to this material. I think it's this one. Yeah, so this just reviews what we talked about. Oops. Trying to find. It's not this one. I think it's there's the cap M one. For two? Nope. I feel like I've done them all. Three. Um. This one. Right. So. Okay, and this one. Okay, so for this one, how are you going to solve this one? I ask you to get beta first. Once you get beta, you can use it to estimate the expected return on the security market line. And then that would, because I tell you, do I tell you this? All right, so information in this table is out of equilibrium. So the information is out of equilibrium. It means that these returns here are wrong. They're not on the line, okay? So you got to find the value of the return on the line, and you're going to do that with the beta. So the beta is what you need, because usually I give you the expected return to the market portfolio and T-bills, right? So you have here the market portfolio's return, and you have the T-bill return. And so the market risk premium is 5.3. Then you're going to use the beta that you estimate with this last column to get the use the cap M ultimately to get the return on the line. And then above the line, remember, undervalued, below the line are overvalued, and that's how you answer these questions. Did you want me to do this, Sandra? Did I already ask that? You want to see this one? Okay. Are there any other questions others have? Because then I'll just do this and then we'll go. Any other questions? Not for Louise. Anybody else? Sandra, do you have any others? Okay. So if you guys have questions, just contact me and I'll meet with you to clarify or lead you in the right direction. Okay, so for this one, let me open it in my iPad. This is the discussion we had. This is what I'm going to reproduce. Okay, so see if I can get it from here. I don't know why they're sorting weird. Okay, let's do this. No, that's not what I want. Let's try this one. And this one. Okay. So let's just do acid A. So to find the beta of A, I use the correlation and then the standard deviation of the acid. So A divided by the standard deviation of the market, which is here. So when I put all that together, what do I get for the beta? There you go, Sandra. It's that easy, right? So let's just do this one and then I'll leave the rest to you guys. 0.2866 6666. Oh, very evil number. 666. Okay. Whatever. Anyway, it's a repeating decimal. And then so that's the beta. So then using the CAPM, I'm going to, okay, to get this value, I'm going to take RF, which is this one. So that's going to be 0.03. So expected return star A. So this is going to be on the line because I'm using the CAPM to find it. So that's RF plus the beta, which is 0.2866. Repeating. This is a beta of A. And then times the market risk premium, which I told you, because this is the expected return to the market, then that means that the market risk premium is 0.053. Is everybody good with that? So we have to just buy the market risk premium for every unit of risk. And so we find that on the line, it's going to be times 0.053 plus 0.03. It's 5% or 4.5. So this is going to be 0.0451933. All right, so that's like 4.51933%. Let's write it as a percentage. So it's going to be, did anybody get a different answer? 4.51933%.
The beta is negative.
Oh, it's a negative. Oh no, it messes everything up. Okay. So let's do this again. This is a negative. Then this is a negative. Then I have to recompute my. So what do you get? See, but it's smaller now. I'll write it as a percent, 1.4806 repeating percent. Is that better? I need to look at my clave to make sure I got the right answers. Luis, you need a new microphone there. Can't hear you.
Oh yeah, that's the answer. That's on the clave.
Okay, so what does it mean? It means that if I go back to the line, let's get the line. I overloaded that one. I shouldn't have taken the whole thing, just the page. What's happening? Okay, so. Well, I'll just cover all this stuff. Okay, so. Going to the line, that falls on the line where beta is negative 0.287. The expected return is 1.48. So let's put everything we can on this chart here. So we have I can't put it on at the same time. So RF is 3%. The market risk, the market portfolio is 8.3%. The beta is negative, so that's going to be over here. So as I mentioned, there can be negative betas. So what correlates negatively with market returns? That will be a negative beta. Here is the beta of any asset that is zero would also be the same beta as the risk-free T-bills beta. And so if I'm at negative, what did I say? Negative 0.28, so it's like right here. That's the beta of this asset, and this thing would go back. The line would continue down here. So it would intersect here. So it's going to be lower than T-bills of 3%. The one that we just got is over here at 1.48%. Let's do that. So that is A. Let's give it a color. It's right there. And beta of A, we found out was negative 0.2. I won't write the number. I'll just put the beta here that it's negative and it's close to 0. And so this one that we were given is higher. It's going to be just above. It'll be out of equilibrium. It'll be just right above, because 2% is just like, it's like 0.5 higher, right? So it's going to be up here. So this is the, actually, this one I will write as, I will write this one out like the notation that I have above as ERA star. But the real A, or the current A out of equilibrium, I guess I'll have to do it in red too, is right above. It's hard to do. But it's not at 3, but it's right above, and it's maybe I'll change the color. And it's out of equilibrium right here, and that's current A. Very bad. I can't get a good. It's not 3. Anyway, I should make this bigger. I should make the whole thing bigger. All right, so this is too bad. These numbers are so. Yes, I could have gone further, because that's 3. I could have gone further to make it 1. Anyway. So it's above, it means that it's above the line. So it's currently undervalued. And because the price will eventually go up, you should long or buy and hold A to realize that the price will rise. How will the price rise? It's because at this level of risk, investors who are right now here and they are invested in a combination of T-bills in the market portfolio, they'd rather be in A, so they will make bids to buy A. They will buy A, and as a result, other people will want, other investors will also do the same, trying to buy A. They will bid up the price, and we understand the relationship is like as the price goes up, to maintain that constant dividend, the expected return goes down. So that's how that will end up back on the line. Questions? It's not the greatest drawing. Okay, so. Questions, comments. So you can do the others? So keep in touch. I'm gonna say buenas noches. Keep in touch if you have questions and or concerns. And otherwise, I am gonna thank you for your interest. I guess you all have to take finance, but I hope this course taught you something. I hope it's useful. And I apologize for all the interruptions, although I don't know what I could have done to prevent it except complain. I hope I made adequate adjustments to the class. Take care. Take care. Bye-bye.
All right. It's been a pleasure. Thank you.
Thank you.